A quantitative trader's single greatest superpower is simple and brutal. They deleted the weakest and most unreliable component in the entire trading chain, the human brain, with all its impulses, fears, and deeply ingrained survival reactions. If you could somehow erase yourself from the moment-to-moment decision-making process, if you could eliminate the emotional interference generated by your ancient biology, your performance would skyrocket. Most traders never realize this, but the truth is that the human mind did not evolve to handle anything resembling modern financial markets. It evolved to help your ancestors avoid predators, find food, stay with the tribe, and react instantly to threats, not to evaluate probabilities, manage risk, or treat uncertainty with calm logic. Every day, your inherited instincts distort your choices. Loss aversion makes you hold on to losing positions far longer than you should because taking the loss feels like a threat to survival. Recency bias tricks you into believing the last few outcomes define the future, pushing you to overtrade after wins and freeze after losses. Overconfidence convinces you that you know what will happen next, leading to oversized risk. Meanwhile, the typical quant dominates, not because they possess magical intelligence, but because they engineered a system that prevents emotional sabotage. They removed psychology from the equation and replaced it with rules, data, and structure. You might not be able to fully automate everything the way they do, but you can steal the mental frameworks that make them consistently outperform. Retail traders wake up, check open positions, scan for setups, stare at charts, and react to every tick, making hundreds of tiny emotional decisions. Should I enter? Should I exit? Should I add size? Should I tighten my stop? And with every micro decision, human biology interferes. You fight the market using instincts built for survival. And you lose. Quants fight something else entirely. They battle patterns, numbers, data sets, probabilities. They spend weeks or months researching and refining a system, backtesting it through years of historical data, discovering a small statistical advantage that repeats over thousands of occurrences. Maybe the system wins 52% instead of 50%. Maybe the average win is slightly larger than the average loss. When they find that edge, they code it into strict rules: entries, exits, risk, position sizing, removing personal judgment. When the system runs live, the computer monitors conditions and executes trades automatically when the predefined criteria are met. No fear, no hesitation, no second guessing. The quant's toughest battle happened long before the trade was placed. They fought it once when they were calm, rational, and working systematically. From that point forward, the system merely collects results. The emotional enemy inside them finds nothing to attack because there is no human making real-time decisions. Meanwhile, a retail trader fights each trade individually, and every trade becomes a fresh battlefield where their own biology ambushes them. The quant won the war once. You fight the same war every single day. When a retail trader enters a trade, they desperately want to know what happens next. They try to predict. They feel like they need certainty before committing. But a quant doesn't try to predict at all. They think in terms of probabilities and expected value. Instead of asking, "Will this trade work?" they ask, "If I took this exact setup 100 or 500 times, what is the average outcome?" This mental shift changes everything. Quants are playing a completely different game. Consider a simple example. A quant discovers a pattern with a 55% win rate, where the average winning trade is $110 and the average losing trade is $100. A retail trader would dismiss this setup as not good enough because 55% seems too low. But run it for 100 trades and the edge generates a clear net profit. Yet most retail traders would abandon it after a losing streak of 5 or 6 in a row because their emotional tolerance collapses. Quants aren't trying to win every trade. They aim to produce positive expectancy over large samples. They embrace being wrong frequently because the math pays off overall. Retail traders obsess over the outcome of each individual trade, while quants focus on the long-term average. Every trade is just one flip of a weighted coin. You cannot force the coin to land on heads. Your only job is to make sure you're flipping a coin with favorable odds and to keep flipping it. Another major difference: quants worship process. Everything is documented in advance: entry rules, exit rules, risk caps, positioning logic, and the exact conditions required for action. They don't ask, "Why did I lose?" They ask, "Did I follow the plan?" If yes, the loss is irrelevant, just part of the statistical noise. If no, that is the real failure. Contrast that with retail traders who define success by whether a single trade made or lost money. Imagine you have a rule to risk only 1% per trade. You see a setup you love and break your rule by risking 3%. The trade wins. You feel proud, but this was not skill. This was luck. Worse, you just taught your brain that breaking rules gets rewarded, so next time you will break them again. One day the oversized risk won't be lucky, and you will erase weeks of progress. Quants simply cannot make this mistake because machines do not get extra confident. The rules execute the same way every time. Consistency allows mathematical edges to compound. Your job is not to be brilliant on every trade. Your job is to execute flawlessly and let the math work. Most retail traders use a massive amount of discretion. They have vague guidelines and then improvise. This setup looks good. Maybe I'll wait. Actually, I'll take it now. That improvisation feels like adaptability, but it is just emotion. It's fear pretending to be caution and greed pretending to be intuition. Every discretionary decision is an opening for emotional error. You skip great setups when you are scared and chase bad setups when you want to make money quickly or recover losses. Quants know humans collapse under pressure, so they design rules while calm and force themselves to obey those rules when stressed. It's like tying yourself to the mast, so you cannot run toward the sirens. Your rational self sets the rules. Your emotional self must follow them. Here's a test. Look at your last 20 trades. How many followed a well-defined plan exactly? Most traders realize they wing it constantly. That is not mastery. That is randomness disguised as flexibility. The more specific your rules, the less space emotions have to distort them. Instead of vague ideas like, "I'll enter when momentum looks strong," you define precise conditions like, "I will enter only if price closes above this level, with volume above this threshold, and a specific indicator confirming." Mechanical, repeatable, emotion-resistant. That is how quants remove emotion. Another psychological gap between quants and retail traders lies in how losses are interpreted. To a retail trader, a loss feels personal. They replay the trade, criticize themselves, and question their ability. To a quant, a loss is a data point, information that helps them evaluate the system's behavior relative to expectations. Losses aren't failures. They are business expenses in a probabilistic environment. Think of a casino. A player may win a few hands of blackjack. Does the casino panic? Of course not. They know the long-term math favors them. Quants operate the same way. Losses are expected and essential to the system's function. They ask analytical questions like, was this loss within normal statistical variation? Does it match historical behavior? Does the pattern of losses reveal conditions the system struggles with? Retail traders ask emotional questions like, why did this happen to me? What did I do wrong? Before entering a trade, a quant already knows what the loss will teach them. They know whether they are testing system robustness or market environment sensitivity or their own discipline. If they execute the rules perfectly and still lose, that is a successful trade from a performance standpoint, because execution was correct. This reframing turns losses into information instead of emotional wounds. When you stop fearing losses, you stop doing destructive things to avoid them. You stop moving stops, holding losers, hoping they return, and revenge trading. You accept the loss, log it, and continue. Another hard truth: short-term outcomes are heavily influenced by randomness. Quants know that predicting short-term movements with precision is nearly impossible, but they also know that patterns with small statistical edges can generate significant profit when repeated over many trades. A 2% edge replicated thousands of times can produce enormous returns. But on any single trade, randomness overwhelms skill. Retail traders want a perfect entry that cannot fail. They desperately search for certainty. But markets are influenced by countless variables and human behavior, making short-term prediction unreliable. Quants focus on long-term tendencies. You can't predict the next coin flip, but you can predict the distribution over many flips. Similarly, you cannot predict your next trade's outcome, but you can estimate the results of hundreds of trades. The challenge is psychological. Your brain hates randomness. When a trade moves against you, your instincts scream for you to take action. But often the correct response is to do nothing, letting your predetermined plan guide your actions. Quants sleep peacefully with open positions because they have accounted for randomness through proper position sizing and preset exit rules. Retail traders lie awake checking charts because they believe each trade should behave predictably, and any deviation triggers anxiety. You must accept randomness. Sample size is another crucial difference. Quants generate enormous sample sizes through systematic trading, sometimes thousands of trades per year. This volume smooths out randomness quickly. Retail traders, however, might take only a few dozen trades per month. With such small sample sizes, even a system with a real edge can experience extended periods of negative variance. During those periods, retail traders believe their system is failing, even if mathematically it is performing as expected. Small sample sizes mislead them. They then jump to new strategies, constantly resetting their sample size back to zero. Quants develop a system, test it thoroughly, deploy it, and then let it run long enough to gather real results. They monitor but resist the urge to constantly tweak. Discipline means trusting your process during drawdowns, but also recognizing genuine failure if patterns violate expectations. Balancing patience and adaptability is one of trading's hardest skills. Risk management is another domain where emotions destroy retail traders. Quants manage risk mathematically, sizing positions with precision and setting predefined stops. Once a trade is entered, they do not interfere. The system handles risk. Retail traders adjust stops emotionally. When price approaches their stop, they often move it to give the trade room, increasing risk out of fear. When a winning trade pulls back slightly, they take profits early, damaging their reward-to-risk ratio. Emotional risk management ruins otherwise good systems. You must set risk rules before entering a trade: stop placement, position size, profit target, exit conditions, and commit to following them mechanically. Once you're in the trade, your judgment deteriorates because you become emotionally invested. You lose objectivity. Never risk more than 1 to 2% per trade. This rule alone prevents catastrophic drawdowns and keeps you in the game long enough to learn. Protect capital first. Profits come later. One of the most powerful skills quants embody is emotional detachment. Once a system enters a trade, they do not care which direction it goes. There is no ego tied to being right. The system acts, logs, and moves on. Retail traders, though, become emotionally fused to each trade. They want it to win. They root for it. Their identity becomes attached to outcomes. This emotional connection clouds judgment, causing them to hold losers too long, exit winners too early, and obsessively monitor charts. Ironically, The more you care about a single trade, the worse you perform. Detachment begins with realizing that any one trade is meaningless in the context of your entire career. It is one of thousands. What matters is long-term execution and consistency. When you internalize this truth deeply enough, emotional attachment fades. You stop fighting the market emotionally and start operating systematically. And as the quant mindset becomes your norm, you stop trying to be right and start trying to be statistically consistent. You stop needing certainty and start respecting probability. You stop treating trading like a personal battle and start treating it like a structured process. You stop obsessing over individual outcomes and start obsessing over disciplined execution. You stop being a participant driven by emotion and become an operator driven by logic. You stop fighting yourself and finally give your edge room to grow. That is how quants outperform. That is how you adopt their psychological framework even without building full automation. That is how you remove yourself, the weakest link, from the equation. That is how you transform from a reactive, emotionally driven trader into someone capable of letting statistical truth guide every action. And once you begin living inside this mindset, your results, your confidence, your discipline, and your long-term performance begin to change in a way that feels almost unfair to the version of you who used to rely on instinct. Because now you understand the secret, the enemy was never the market. The enemy was always your own mind. And the quant mindset is the weapon that finally lets you win.